Welcome to The Explainer. I am so thrilled you're joining me today because we are going to completely tear apart a number that lives rent-free in the minds of professionals everywhere. You know the one, the six-figure salary. We're going to look at how a $100,000 salary actually behaves in the real world of 2026, and trust me, it is a pretty fascinating journey.
For decades, hitting that 100K mark, well, it's been the ultimate professional milestone. It's the finish line, the American dream. But we have to ask a really hard question right off the bat here. Is $100,000 still the American dream in today's economy? Or is the face value of a six-figure salary just an illusion masking a much more complicated financial reality?
Okay, let's dive into this. On paper, that beautiful, pristine 100 grand in gross pay looks absolutely fantastic on a job offer. But in reality, the true net pay, the actual tangible money that finally hits your bank account, tells a totally different story. There's a massive and honestly kind of shocking gap between what you see on paper and what you actually get to spend. So today, we're going to figure out exactly where all that money goes.
Section 1. Anatomy of a paycheck. Slicing up 100K.
Think of your $100,000 salary as the protagonist in our story today, and right out of the gate, it faces some really heavy antagonists. Just think about how fast this pie gets sliced up. If we use a 2026 Oregon paycheck as our example, federal taxes take out $14,768. Then, state taxes grab $7,640, and FICA and other deductions carve away another $7,773. Just like that, almost 30% of the pie is instantly gone, leaving a net pay of just $69,819.
But wait, it actually goes deeper than that. Let me introduce you to a brilliant metaphor, the taxberg. Just like the iceberg that sank the Titanic, a massive portion of your tax burden is actually hidden beneath the surface, just waiting to sink your paycheck. Did you know it costs an employer an additional $8,070 in taxes just to pay you that 100K salary? When you factor in these invisible taxes that your employer is paying on your behalf, the math gets wild. It literally means that every time you spend $10 of your hard-earned money, $3.83 is actually going straight to the government. Which brings us to this number, 35.4%. Once the employer's side of the taxberg is brought to light and actually factored into the equation, your real tax rate isn't the 30.2% you see on your pay stub. It is actually 35.4%. That is an incredibly heavy toll before you've even bought a single bag of groceries.
Section 2. Best and Worst Tax States, the 2026 Rankings.
Because, as we're about to see, geography completely changes the math on your salary. Looking at data from the Tax Foundation, which neutrally measures the total state and local tax burdens across the country, Wyoming, Alaska, and Florida are the absolute most tax-friendly states, boasting total tax burdens of just 7.5%, 5.16%, and 6.97%. But on the complete opposite end of the spectrum, New York carries the heaviest burden in the entire nation, taking a massive 12.47% of personal income. Now, a huge driver of these rankings is state income tax. In 2026, exactly 9 U.S. states have a 0% income tax. And, surprise, surprise, it's not a coincidence that all 9 of these no-income tax states rank squarely in the top 15 for the lowest total tax burden in the country. Eliminating state income tax is just a massive advantage for your paycheck. And this perfectly illustrates why this geographical divide matters so much, especially for high earners. Say you make $500,000 a year in California, you are handing over $51,259 in state income taxes alone. But if that exact same earner relocates to Florida, their state income tax drops to zero. Zero. That is over 50 grand a year in savings just by changing your zip code.
Section 3. The low tax trade-offs. The catch. But hey, before you pack your bags and call a moving company, we need to introduce a little plot twist. We really have to ask a pivotal question to challenge a super common assumption. Does a 0% income tax automatically equal a lower cost of living? Like, does moving to a no-income tax state actually make your life cheaper overall?
Well, the crucial point here is that states still have to fund their roads, their schools, and their services somehow, right? If they aren't taxing your income, they're setting up hidden tax traps elsewhere. Texas, for example, hits you with a 1.6% property tax. Tennessee hammers its residents with a nation-leading 9.55% sales tax. In New Hampshire, they have zero income and zero sales tax, but they make up for it with a brutal 2.05% property tax.
Let's look at a really stark comparison to drive this home. Both Texas and Wyoming have a 0% income tax. But If you buy a $400,000 home in Texas, that 1.6% property tax means you're paying $6,400 a year. In Wyoming, with just a 0.56% property tax, you're only paying $2,240. So that exact same house in Texas will cost you an extra $4,160 a year in property taxes compared to Wyoming. The no income tax label really doesn't tell the whole story.
Section 4, where $100K goes furthest. City purchasing power.
So what can $100,000 actually buy you when you walk out your front door? $29,420. Just let that shocking number sink in for a second. Based on an extensive 2026 study by Smart Asset, this is the true purchasing power of a $100,000 salary in Manhattan. Your six-figure salary is effectively worth less than 30 grand.
How in the world does it shrink that drastically? Well, we can break down exactly how this happens. First, New York has a progressive state tax that scales all the way up to 10.9%. Then, New York City stacks its own local city tax, up to 3.876% right on top of that. And once you finally survive the taxes, you're hit with a massive, brutal cost of living premium on housing, groceries, and utilities that simply devours whatever is left of your New York salary.
But let's contrast Manhattan's brutal math with some other cities. If you take that exact same $100K to Oklahoma City, Corpus Christi, or El Paso, your money actually survives. In these cities, lower taxes and a much more forgiving cost of living mean your salary retains over 90% of its face value, leaving you with over $90,000 of true purchasing power. Now let's see how this purchasing power builds dynamically over time, using Houston as our example. Not only does a six-figure salary go far in Texas, but in cities like Houston, purchasing power is actually improving year over year. A $100K salary in Houston was worth just over $78,000 in 2024, but thanks to shifting economic factors, that exact same salary in 2026 feels like nearly $85,000.
But to properly contextualize the city data, we also have to look at the changing goalposts. To maintain a standard middle-class lifestyle in Houston right now, which basically means the ability to own a home, raise kids, and actually save money, you need a household income between $42,907 and $128,722. That lower threshold, it means you now have to make over $1,100 more than you did just last year just to keep your middle-class status in the city. There's a quote from the Smart Asset study that really brings this all together perfectly. It says, "The cost of living varies widely across the country, affecting how much purchasing power remains after necessary expenses. Hitting that 22 or 24% federal tax bracket on your $100,000 salary? Well, that's really just the tip of the financial iceberg."
Which leaves us with one final incredibly important question to consider today. Are you going to let the taxberg sink your hard-earned salary, or will you rethink your location to rescue your purchasing power? Understanding these numbers is the first real step to taking control of your financial geography. Thank you so much for joining me for this explainer. Keep learning, keep questioning, and I'll see you next time.